Welcome everybody to this webinar. Hi, Michelle. We'll be hopping, oh, there's Heidi, hopping back and forth between mostly screen share, but there'll be discussion at the end. And those of you who have cameras, if you feel like turning them on, that would be great. My name is Susan Brown, and I work with Cameo on a lot of micro lending, CDFI development. Hi, Terry Gouveton. And we also have another guest speaker here, Carmina Lass, who's with Credit Builders Alliance, who is, I hope you unmute yourself at some point, Carmina, and I'm hoping she's expert in some of these matters, perhaps more than I am, so I hope you just chime in, Carmina, whenever you have something to add or to even perhaps correct. So I am going to go ahead and share my screen and get started with the webinar, and let's go. So here we are, how to improve your clients' credit scores. And here's what we are going to do today. As I said, I'm Susan Brown, working on micro lending with Cameo, and Carmina Lass is the Chief Program Officer of CBA, who is also on the call with us. And we're going to go over what is a credit report, reading a credit report, what is a credit score, and ways to improve credit. We're going to talk a little bit about advocacy, and then I'd also like to encourage you to look into Credit Builders Alliance resources for more in-depth information about this. I wanted to add one slide today about why we're doing this. We think this is a very timely discussion. Many of our members work with those who are left out of traditional credit opportunities, and those banks and many lenders use credit reports and credit scores to make credit decisions, and these people become what can be known as credit invisible. They're out there working in the community, but either have no credit or maybe poor credit. Credit invisibles are much more susceptible to users' loans, such as merchant cash advances and payday loans, which can really wipe out the financial resources of a community or a household. Credit is a very important element of business growth and wealth creation in this country. Pretty much everyone who has built a strong business or created wealth of some sort in this country used a credit as one of the tools to do that. We also know that, or we suspect that the new guidelines for the SBA disaster loans might be made on credit score alone. They're trying to streamline the process, which is wonderful, and make it very quick, be able to make quick decisions. But if they're making it on credit scores alone, that may leave out people who we think really deserve and need credit. And we also probably all know that people are going to be adversely affected by this virus pandemic and the economic issues and problems that it's causing now. So jumping right in, what is a credit report? It's a detailed borrowing history with identifying information about the person, such as sometimes has their past job, places of work, places they've lived, social security number, date of birth, things like that. It does list all the loans and credit that are current, that the person currently has, and it also usually contains some closed accounts as well, at least for a while. So it gives you a pretty good snapshot of how the person's been, what kinds of credit the person has been using, and how much and for how long. It shows something called inquiries on the credit account, which is just how many places has that person applied for credit recently. It also has information on public records and collections, which is public records, or if you have a tax lien or a civil judgment, child care slow pays, things like that. So if there's issues that people owe money, it can show up on the credit report from various legal, legal situations.
And Susan, if you don't mind, if I just jump in with one quick note.
Please, this is Carmina.
Yes. Hi everyone.
Please jump in.
Just a quick update on public records as that, historically the public records section of a credit report did include all kinds of public records, including bankruptcies, tax liens, civil judgments, but some recent changes that came out of the National Consumer Assistance Plan has actually found wide inaccuracies in some of those types of records, particularly civil judgments and tax liens. And so as of this moment, all of the major bureaus have removed those particular records from the credit reports. So somebody might still have an outstanding judgment, let's say, or a tax lien, but they're likely not to, they would not see it on the credit report at this time. So that's just something to flag that people might have those kinds of records, and you might need to go to local courthouse databases to see if they have those outstanding debts, because they're not appearing on the credit report.
Thank you, Carmina. I have a slide on that, but I might have gotten it a little bit wrong. So when we get to that slide, you can tell me if I got it wrong. But thank you for that. Thank you very much. So what kinds of specific credit information is on these reports? It will tell you all the different types of loans: credit cards, car loan payments, mortgages, student loans, that kind of thing, that this person has. It says the type of account, the date opened, the credit limit or original loan amount, and the current balance. It often gives a monthly payment. It will tell you the payment history for the last couple of years, and of course shows things like delinquencies. And we're going to look at some examples in a minute, so I won't dwell on that. Credit reports, if you're not used to them, can look very weird and intimidating. So what I'd actually like to do is I'm going to, anybody who wants it, I have something called a TransUnion Credit Report Guide. That's a document created by TransUnion, which is one of the credit bureaus, that is an explanation of how to walk through their credit report and explains what all the sections mean. And I've just highlighted some of the things here. It gives you a sample credit report. It tells you current manner of payment codes. I'm going to show you this in a minute. Details on each credit report section. It tells you a teeny bit about scoring, although not very much, and some other things there. Now, this is a credit report guide that I got a while ago, so it may I may perhaps need to get an updated one, especially given what Carmina said. But I just wanted to show you this. And the main thing, when I use this to teach our underwriting class, just so people can start understanding how to look at a credit report for underwriting decisions. And the main thing I want to show you, this is a 10-page document. And if you'd like to get this document, we're happy to send it to you. But it's this page with the codes on it that might be the main thing I want to highlight, is that you'll find a bunch of letters and numbers and things like that in different parts of the credit report. And there is a page here that tells you what all those letters and numbers mean. And there's this piece in particular I will go over in just a little bit, the current manner of payment. But there's other, as you see, there's all these other kind of codes here. So you can refer to this to kind of interpret the credit report. So that was one thing that is available, and I wanted to let you know that we can send that out for you, or you can just Google it, because I think I pulled that report a few years ago, and maybe there's something more up to date. The other thing I wanted to do is just show you an example. This is just from our case studies. It's got real numbers, but it's not a real person in here, just to help you get a little familiar how to look at a credit report. Each credit bureau, I think, formats their credit reports a little bit differently. So it's not a one-size-fits-all things. And this is a TransUnion report, but I've seen TransUnion reports that look quite different than this. But let me just give you a little bit of help navigating these documents. And then hopefully this will be enough information that when you are looking at credit reports of your clients and borrowers, you can find your way through. So this top section is some of that demographic information with date of birth and social security number and address and so on. And then the next section is this summary section, where it's kind of a roll-up of all the trade lines, which are going to be below this, but it tells you how many lines of credit or different types of credit products this person has currently on their report. If there's any that are negative, and how many are current. You can see all this history of negative trades, current past due. This person's in pretty good shape. These are all zeros. You know, anything that's late will show here how many inquiries. This person has actually had 5 inquiries recently. Maybe Carmina knows. Is it within the last 6 or 12 months? Do you know, Carmina, how many months the inquiries are?
Yeah, so the credit report will it'll reflect the inquiries over the past 24 months. However,
24.
it's only the past 12 months in the inquiries that occurred within the past 12 months that actually have a material impact on the credit score if you're talking about the hard inquiries.
Got it. Yes. And one way that people look at these inquiries is if the person has been shopping for a lot of credit. This person has been maybe applied for 4 different types of credit in the last 6 months. The oldest trades, which is maybe, you know, the line of credit that's been on there the longest. Here's also the account balance, how much is currently outstanding, what the total current monthly payments are totaled up, the credit limit, the high credit limit, and the total revolving balance, which are the credit cards. So this is just a summary, and you can kind of get a snapshot of what's going on with the person by looking at this. The next section on the credit report are these credit scores, and there's all kinds of different scores out there these days. I think the SBA and many of the banks still use the FICO score. It's pretty common, and I'll talk in a little more detail about the credit score later. But because here you'll see a bankruptcy score that's not typically used in our industry, but the FICO score certainly is. I think the part that's the most helpful to look at are these are the actual trade lines. So every single credit card, auto loan, mortgage loan will be these little separate sections here. And the thing about this particular format of the TransUnion report that's interesting is these are the headings for all these boxes. And then here's the answers for those headings for each one of these credit lines. So it's a little challenging. So the firm name is in this upper left-hand corner. And in this case, in this first trade line, it's the Chase card. When it was opened was in March of 2017. The credit limit is $2,000. That current outstanding balance is $1,065, and the current minimum monthly payment is $30. So that's kind of, you know, that's how you have to keep going. The account number would have been in this square. The type of trade credit is right here. It's a credit card. So you kind of have to hop back and forth between these headings and each individual line of credit. So it's a little bit of you have to kind of memorize what these boxes are. The one that is particularly helpful, I think, if you're helping a client with this is this pattern box, because that will tell you right here whether they've been making their payments on time. And if you go back to that TransUnion report right here, you'll see that that's what this mode of payment is 1 means paid as agreed, 2 means 30 to 59 days past due, 3 means 60 to almost 90 days past due. So when you see a bunch of 1s right here under pattern, it means that the person has been paying on time. Now this person has 2 months of data here, 3 months of data here, 4 months of data here. If we keep scrolling down, so here's another credit card, another credit card. These are mostly credit cards here, a Sears credit card. And here's one that they've had much longer. So all these ones mean that they have that many months of on-time payments. So that, and I thought about bringing up, there's, you know, other credit reports where you'll see 2s and 3s here. Sometimes you'll see an X, which means data not provided. But it's those slow pays. If you see 2s and 3s here, that really hurt the credit score and quite a bit. And we'll get to the other part. The other thing that hurts this credit score quite a bit is if their current balance is like more than 30 or 50% of the total credit line. That's another thing that tends to lower the score. If you're tapping out your balances, your total credit limits at a high amount, that can lower your score. And then at the very bottom here, there's the inquiries, which I think for our conversation today isn't that important. This particular report doesn't have it here, but if there were collections or something, they would show here in the first few sections, because that comes near the top. Did you want to add anything else just on how to read these things, Carmina, that I haven't said?
Yeah, sure. I think I would note just that there's like you had mentioned, there's a lot of different formats, and Credit reports are also customized to whether the audience is a lender, looking at more of a summarized version of that person's credit history versus something, a credit report that would be designed for a consumer education purpose. So if you pulled a credit report from annualcreditreport.com, you might find more detail, and the coding also might be different. So the manner of payment codes that TransUnion uses are not necessarily going to be the same, numbers or coding that you'd find on other credit reports. So I think whatever report you're using, you just want to make sure that you identify the key or the right user guide to help inform you how to read that particular type of credit report.
Right. And do you find that most people can Google the user guide for that particular one and find it fairly easily online?
So I would say that when you pull reports from annualcreditreport.com, the consumer, facing types of credit reports, they usually have the information on how to read it embedded within the report. If you are purchasing credit reports for underwriting or even for coaching or counseling purposes, you should be able to get the most updated user guide from the entity that you're getting that data from. So if you are purchasing TransUnion reports either for underwriting or for educational purposes, you should be able to get an updated user guide for that particular type of report.
Okay, thank you. And we're going to, yes, go ahead.
Oh, there's a question in the chat, Susan, and we might as well do it when we were on the previous slide. It says, what does it mean when there's a dash? Like, I think there was some places on the credit report where
let me see, where were there dashes?
Go down to the trade lines.
Yeah, some of the dashes. So right here, that used to be an actual account number, and I deleted it. In other words, these are actual numbers from somebody's credit report, but with everything identifying the person eliminated. So this dash, for example, just means that there used to be there used to be an actual account number here. And I think some of these other blanks are just where there might have been numbers. Let me go up and look here. Or they're just maybe where there was no data to begin with. Okay, so let's keep going. So that was great information, Carmina, and I've got a little more on that too. So there's the credit reports, which are kind of challenging to navigate themselves. So what we want to focus on today is the credit score, as we said, because in these times, we find that maybe some really important sources of credit are relying very heavily on these credit scores, which for those of us who help people who don't haven't had an opportunity to participate actively in traditional credit resources is going to be an issue. So what is a credit score? A credit score is a mathematically calculated number based on information in a credit report. And the most common one that's used at this point is FICO, or certainly the one that we're most familiar with. So the FICO credit score is based on payment history, which means paying on time, the amount of debt, how much debt is carried versus how much credit has been extended. We're going to go over some of these in a little more detail. The length of credit history in general, a longer credit history will increase your FICO score. New credit, it depends how much you've been opening credit recently in a short amount of time will affect your credit score. And credit mix, in other words, having both credit cards, retail accounts, installment loans, and mortgages, all that kind of, the bigger the mix, the higher your score. So if I have the right information here, FICO, this is kind of the weighted average of how the score is, whatever the mathematical score is. And you can see payment history is huge. And how much you've tapped out your current credit lines is next. Length of credit history is the third element. New credit and credit mix are fourth and fifth. I did want to mention that one of the other large credit agencies, Experian, uses something else called a Vantage score. It has the same numeric spread, which we'll go over in a minute, but they have a slightly different formula there. It's not exactly the same, but do you have anything to say about the differences between FICO and Vantage score, Carmina?
Sure. So, even with the FICO score, FICO has lots of different scoring models. So they all generally, follow those same categories that you had shared. And then Vantage Score, Vantage Score is another company that was, created by the three credit bureaus to create an alternative to the FICO score. And it does have very similar factors in terms of payment history being the most important factor, as well as use of revolving debt being also highly influential. I think it's just important for the borrower to really understand what score their lender is using when they are applying for credit, and just to also understand that that many times when people are using apps like Credit Karma and things like this, oftentimes those apps are maybe using the Vantage score. So just understanding that calculation might be similar, and generally that positive payment history is going to drive the credit score up, whether it's Vantage or FICO. But there might be some differences because of the variations in those models, and just to pay attention to that and what score the lender is using.
Do you tend to find that FICO and Vantage are within earshot of each other on any individual, or can they vary a lot?
It can really depend on a lot of different factors. Again, even within the Vantage and FICO score models, there are different there are different score models for different types of lending purposes. For example, there are score models designed for auto lending. There are also more recent scores. So each of these companies is constantly trying to make their score more accurate. So it just might depend on which score is being used and what factors they're weighing more heavily than another. So you can
I see.
One is not always going to be more than the other, and there's not necessarily a point range. That's why we encourage people to just really focus on those behaviors that they can take on that will ultimately drive their credit score up across the board.
Okay, great. Thank you. That's very helpful. So just to put this all in perspective, I just wanted to tell you, banks, I think the magic number for a lot of banks on FICO is like 680 or something. That's where they start to feel comfortable thinking that someone's a good credit risk. The SBA Disaster Loan, historically, their starting point's been around 600 on this FICO score. And so, and that's relatively high for some of the people we serve. And the reason is that, community lenders are willing to start very low. And in fact, some of our CDFI lenders have no minimum FICO requirement because of their mission to serve the underserved and work with people in a much more intensive way on building credit. So as you can see, there's a real range of where different institutions that are offering credit are willing to step into this. And particularly, again, if you're working with people on this disaster loan, and I don't know if the tipping point on the new regulations will be 600, but it's been there historically. So I just sort of want to give you guys an idea of where the numbers kind of fall. So here's what I had on public records, is that there's this whole thing on, state and county courts, bankruptcy, civil judgments, tax liens, debt that's overdue, and collections. And what I had is that because public records now need to have name, address, social security number, date of birth, and many public records don't have this, that they've just been removing. Are you saying, Carmina, they've already removed all of it? Or that they are only removing the ones that don't have the full information?
Yeah, so they rolled this out gradually, and at first they began, removing the records that they deemed to be inaccurate. But then they just determined that they were going to remove all civil judgments and tax liens across the board from the three main bureaus from the credit reports. Now that could change in the future if they're able to all jointly come together and determine that they can ensure that they meet the accuracy requirements that are outlined in this in the National Consumer Assistance Plan. Then at that point they might come back on, but that's likely going to be further out in the future, bankruptcies do remain on the credit report though. So those are the one public record that you would still see.
Okay, thank you for that clarification. Appreciate that. So if the things that really get people turned down for credit, but in addition to the score, well, the score itself can, but certainly foreclosure, repossession, bankruptcy, collections, recent collections, lots of slow pays. I have looked at credit reports with lots of slow pays on mortgages, credit cards, vehicles, recent slow pays. This child support, maybe child support's not showing anymore, and unresolved public records. So maybe those last two bullets are no longer the case. But certainly, if, as you can see, it's not just the credit score that shows your use of credit, but those individual credit lines will show if you've been paying on time and if you've had problems managing credit in the past. And if you start to get good at reading those credit reports, you can also see if people have done too many inquiries, tapped out, gotten too many credit cards, maxed out the credit cards. There's all kinds of things that can start to be red flags in general, not just for the FICO score. So let's start in on our list of things on how to improve credit, and then hopefully have plenty of time left for questions. So as I think we've talked about, is making payments on time is really the best way to improve your score and make basically your credit report look good and appealing to new creditors. So making at least the minimum payments on time, it keeps your accounts out of collections, it lowers, you can qualify for lower interest rates, it improves your eligibility for larger loans, and you avoid late fees. So really, if there's anything you can help your clients to do, is to make their payments on time and educate clients about why that's so important.
Susan?
Yeah.
If this is on a credit card, let's just say it's a credit card, would you just say make the minimum payments and pay them on time, and
well, this isn't really a credit management course, but yeah, at the very least, make the minimum payments. One of the case studies we have in our microlending essentials is there's a couple that have just kind of gone crazy with credit cards, and they just got lots of credit cards and loaded them up, and you kind of it makes you go, you know, how much are you using your credit cards? And once you start making just minimum payments on lots of cards, you're accruing a lot of interest. And again, interest on credit cards is high. It hurts if you're working with low income clients, it hurts them to be paying 12, 15, 18% interest on large balances. So I think part of that is a larger credit counseling question about helping people not take on too much debt. The problem with making a minimum only payment is that you're really not knocking out much on principal, and depending on what your balances are, it could be taking up, you could be accruing lots and lots more debt and not realize it. Did you have anything to add to that, Carmina?
No, I mean, I think the most important in terms of just maintaining is to make sure you're making that payment on time, and right. And that you're not incurring any negative reporting, and then of course, outstanding revolving debt is critical. So if you have the ability to even make a small amount over the minimum payment, that is always
advisable.
It's always great to try to just bring down that revolving debt a little bit.
Yeah. Another way to improve credit is to keep balances lower, keep them lower, get them low. Credit cards under 30%. So here's a quote from experienced Director of Public Education. 30% level is not a target, but rather a minimum limit. Exceeding that will have exceedingly negative impact on credit scores. And here's somebody from the FICO saying consumers with FICO scores of 800, now 800 is an excellent credit score, on average use 7% of their available credit. So I think we can see on this, and that even that credit report, that sample credit report we just used, it's probably not known to a lot of our clients that we work with in our industry how much it might hurt them to be getting up to the limit of their credit limit on their credit cards, and how that hurts. So working with clients to get under that 30% is like a really critical thing you can do to help improve their scores. And as you can see, the lower you can get it, the more unused balance you can have on those credit cards, the better.
Yeah, and I would just say, even if you have somebody who is really debt burdened and they're starting at that close to that limit at that 90%, 30% might feel like a long way to go. But even if you can help them reduce their utilization from 90% to 60%, yes, they're not at the lower end of the spectrum yet, but that's gonna have a positive impact on their score. So it's just always want to focus on bringing that down, and then especially not having any one account maxed out as well.
Oh, perfect. That's great advice. Thank you. Dispute inaccuracies. I found the statistic that 25% of consumers have inaccuracies on their reports. So under the Fair Credit Reporting Act, the reporting companies are responsible for correcting inaccurate or incomplete information. The Federal Trade Commission has some information on that. I have the link there. So these are the types of errors: name misspellings, duplicate accounts, incorrect accounts, fraudulent accounts, information or accounts from an ex-spouse, incorrect payment statuses, outdated information, incorrect date of first delinquency on a collection account. There's lots of, my name, Susan Brown, very common name. When I went to go check my credit reports to get my home mortgage about 10 years ago, there were 6 other Susan Browns on my experience credit report, and a couple of them were dead. I mean, it was kind of like this crazy mess, and I had no idea. And I did learn doing that too, because I had been looking at, I think, my TransUnion report, but that you actually have to look at you have to pull each agency, because they don't look at each other's stuff. So you can be totally clean on a couple of the credit agencies and have a mess on another one of the agencies. So it's possible by correcting errors, you can improve your client's score right there. I'm sure once I got all those other Susan Browns off my credit report, there was, I think, 7 or 14 derogatories. I mean, there was all kinds of stuff that my credit score rebounded fairly quickly. We can send out this slide deck. You can do this by mail, but all the credit agencies have online dispute links, and you can just Google them. They're easy to find. That's all I did today. But this is something you can do with your clients, is actually help them get online, fill out those dispute reports, document the inaccuracies, and start logging reports and disputes to correct their information. So here's some other things I found about improving credit, is that even making very small payments, micro payments throughout the month to keep balances down can help. So that's kind of a pain, but with online situations, you can do online payments these days, you can do it. But if you're working with a client that gets cash weekly or something, maybe there's some way they can make little payments throughout the month, and that might help them get their score down. If you can talk to your credit card vendors and see if they can get the credit limits raised, but not use more credit, but just get the credit limits raised, that will have an impact. Keep unused cards open, catch up on any late payments, and to communicate with credit vendors to clean up problems. Arrange to pay up and ask a creditor if they will consider no longer reporting missed payments to the bureaus if they get caught up.
And I would just add one more comment on that last bullet, is that really, creditors are supposed to report accurate information. So even if you do have some, missed payments, I think the focus, it's always good to just have the focus be on forward momentum and getting caught up, and then knowing that your payments will be reported positively, going forward, even if you had some past hiccups. And eventually the score will improve if you're talking about an open account. Sometimes, there are reports that, some collection companies will offer a opportunity to take a payment and then remove a missed payment, but the credit bureaus actually frown on this because it violates the Fair Credit Reporting Act that really requires them to report accurate information, even it's in the past, and not alter that history.
All right, I'll edit that bullet then. Thank you, Carmina.
Yeah.
And I just saw in the chat room that someone said, keep unused cards open, ? You know, I have to tell you, when I applied for my mortgage, this is years ago. First of all, the mortgage broker just begged me to keep all my balances low on my credit cards. And I looked at my credit report and I swear there was an American Express card or something that I'm pretty sure wasn't mine. And he said, oh, don't take it off until after your mortgage closes, because it had no balance. But he just said, believe it or not, that open, unused credit card improves your credit score. So if people have the discipline not to use credit cards that are just hanging around, or just rip them up and throw them away, believe it or not, it does help your credit score. The one thing I did, go ahead, Carmina. Yes.
Oh, I was just going to say, so we encourage that, that people, first of all, another reason why you want to keep the unused cards open is because when you close an account, first of all, it'll have an impact on it could have an impact on your length of credit history. So if you close a card, maybe it was the first credit card you ever had, then eventually that goes away, and then it looks like you have less history there. You also, your credit score is really dependent on recent activity. So you want to make sure that that even if you have some accounts that you're not using maybe on a monthly basis, that you at least have a couple, 2 or 3 or more active accounts that are generating that regular positive activity. And then for those cards that you're maybe not using, you do want to keep them open again, because that has an impact on your credit limit and also your length of credit history. But we do encourage you to use them at least once per year, and that because otherwise a creditor might actually just close them for you. And then again, that can have some of those negative impacts. And I think the only exception would be if you have some kind of exorbitant annual fee that you want to avoid. I think it makes sense to maybe close cards in those cases. But yeah, generally that's
Right.
great advice to keep those open.
And I think I just saw it in the chat room that sometimes the agency might close the credit card for you. But it's helpful to talk to your clients about some of these points that I'm saying and Carmina's saying. I worked with a client once who had some credit cards and he never used them. And he said, well, I thought it was better to pay cash. And I said, but you're not creating any kind of track record unless you use your credit cards and pay them on time. And he didn't even know that. So I think that idea of just helping people with responsible, manageable amounts of credit use is the way to help them step into this world. And the one thing I wanted to share, one other document with you all, that this is on our website, and I'll give you a link to it towards the end, but this is from the Consumer Data Industry Association, which does a lot of work in this area. And they had, helping consumers avoid credit problems during this current pandemic. And the main advice is consumers should contact their lenders and creditors. That, and as you scroll down, again, this is available to you online, is that if people can get forbearance or deferred payment plan, it doesn't necessarily impact your FICO score necessarily, and consumers that have been impacted directly or indirectly by the virus are strongly encouraged to contact their lenders and creditors. So avoiding creditors is not a good way to go. I just talked with a local lender in the Bay Area, and she just loves it when her clients are calling her saying, hey, I think I might have an issue, let's have a conversation. And it's definitely the way to go. But you definitely want to help your customers know what to say, know how to have that conversation.
Susan, there's another question in the chat about creditors closing accounts if not used in 4 to 6 months. Do we know anything about that?
I've had some stay open much longer than 4 to 6 months. So
I think it's just going to depend on the creditor and their policies. So, I think definitely some will keep them open for much longer. Some others might close them on a quicker basis. But, we say, for a credit card, use it, once every 6 to 12 months as a best practice.
Yeah. I have a Macy's account. So I swear it'll never close. Anyways, and I don't use it. This one is much harder to do. It's a longer term strategy, but again, it's that mix of types of credit. It only has about a 10% impact on your FICO score, but helping people who are just in credit cards, maybe get an installment loan for a car, or helping people step into their first mortgage, or just having a mix of credit is another way to improve your score, even though it's more of a minor element. Pulling reports. So here, I think Carmina might have said annual credit report, Credit Karma. There's various places you can get reports. You can sort of do it by mail or phone, but I think doing it online is the way to go. One thing, when you pull your own credit report, you have the right to pull a credit report from each credit agency every 12 months, once a year. It generally doesn't have this FICO score in it. You have to go to other sources, or you have to just pay. It'll actually ask you. I think, isn't that right, Carmina? You can go on these places and say, hey, would you like your credit score? But it's for a fee. During this challenging time, if you're really stepping in and trying to help clients get loans or manage credit, if you're helping with disaster loans, if you're talking to your funders about redirecting some of your scope of work on your funding for the content and how you're spending your grants and money, I would say help clients pay that fee to get their credit score. Use that, talk to your funders and say, hey, we'd like to start paying for people's credit scores so we can help them more effectively navigate this and see what they're qualified for and help them improve their credit score. I think it would be a great use of money at this point.
Yeah, that's right. So when you get a report from annualcreditreport.com, you just get the report, and that's really the best place to start to really understand what's on the report and what would be driving the score. And then, as you said, it would be an additional fee to purchase a FICO score in particular. A lot of times you can find a Vantage score through a service like Credit Karma at no cost. But again, it might be good if you're going to purchase that FICO score to also figure out like what's the most relevant FICO score for that that client's person. Like what score model, specific FICO model is the lender using. Another thing that I'll just note is that a lot of our nonprofit members in our network utilize a service that we have that allows them to actually purchase the reports and the scores on behalf of or for their clients, so that they don't have to go through the hurdles of getting it through annualcreditreport.com, and sometimes the challenges with answering security questions. So that's another thing that nonprofits can look into, how to actually purchase credit reports for educational purposes, to have there ready for their clients to provide them with that coaching and counseling support.
Oh, that's fantastic. And we're going to talk a little more about Credit Builders Alliance in just a minute. I just thought I'd give you, I think Carmina is doing this great job of helping us be cheerleaders for our clients, because people with low scores are better positioned to make larger gains. And so it really is possible to achieve some bigger jumps in credit score, because there's more room for improvement there. So I think if someone comes in with a lower score, just start in on some of these tactics and you might be able to do a lot to help them improve their score. I do want to just make a quick pitch here for advocacy around credit access wealth. There's this great video, again, that's embedded in this slide that I hope you listen to. It's about credit invisibles. There's an article here by Oliver Wyman about alternative data and unbanked. And then what I want to talk about is quickly say that here's a link to all kinds of resources, including 3 tip sheets from Credit Builders Alliance, and there's an SBA website for COVID assistance. Again, this is on our website, and you can get these slides and get more information. And let me jump quickly to advocating for Credit Builders Alliance. It supports non-traditional nonprofit organizations to build credit and financial access for disadvantaged individuals. They have credit as an asset training. There's a link, but I also want to jump over to your slides very quickly. Carmina, let me hide the auto ribbon and just say you can get these slides as well from us. And let me just click here and have you go ahead and talk about this, Carmina.
Yeah, sure. So we have our signature training is called Credit as an Asset. It is all about helping people strategically build credit in order to achieve their asset building goals, whatever they might be. So this training equips practitioners to help support their clients in achieving those goals. We're offering it as a 6-week virtual course. It begins actually on Wednesday. So go ahead and sign up if you're interested. We're going to go through in a lot of detail around credits, the importance of credit, credit realities, credit scores, understanding different credit building products that can help people establish and rebuild credit. So things like secured credit cards and credit building loans, those kinds of things. We talk a little bit about managing debt with credit building goals in mind, and really just a lot about how within your programs and within your practices, you can support your clients wherever their starting point may be. If they're starting with no credit, if they're starting with challenged credit, we kind of walk through those steps. So that's it's going to be a live webinar series, and we also have some other trainings through our CBA Training Institute that we have discounts for CBA members, but we do have an extensive training on reading credit reports that might be of interest to some of you. It goes into reading a credit report. It's in a self-paced course, so that's not a live course, but that's something that you could just hop on and take anytime. So probably a good time to do some training since everybody's at home. Many of us are at home. So, and feel free to reach out to us if you have any questions about membership, our services, or our training services in particular.
Thank you so much. And Carmina jumped on this call last minute today. I appreciate your participation so much. Thank you.
Yeah. Well, thank you for having me.
Oh, well, I just, there's such a resource. So we have some time for questions, and I know Heidi's been monitoring the chat room. Are there questions we haven't answered yet, Heidi? Where are we?
Yeah, there's 2 questions. One was, how soon can a score change if everything is done correctly, and by how many score points? So I think like you just said, 100 points. If you have a low score, you have lots of room for improvement.
I don't know if we can answer that exactly, unless, I don't know if you have any guidelines on that, Carmina.
Yeah, it's really hard to answer that with any, because it really just depends on the starting credit profile.
Mm-hmm.
I can share a couple things that we know. So for when people are starting out and they absolutely have no credit score, no credit history at all, and they're credit invisible, like we've been talking about, it's possible to establish a prime credit score in as little as 6 months. It does typically take at least 6 months of activity, because the FICO score is really driven by at least 6 months of activity, but somebody can get all the way to a prime score when they're starting with nothing at all. It's a little bit different when somebody's starting with maybe a poor score, because they have more information, more data in that file that is, maybe working against some of the more new positive activity. So that's going to really depend what their barriers are. If they have lots of collections, or maybe they just have one old collection, that might be a little bit easier to overcome. But I think that a lot can happen in a period of 3 to 6 months for somebody to make some improvements. And I think there's always something that you can do to improve your score.
Great. The other question here is, what's the best way to ask for a credit increase on a credit card? Do you have an answer for that, Carmina? I've done it once. I just called my credit card company and talked to a customer service representative. Is there another way to go about it?
I think that's the best way. I think contact your representative and see what the options are, and maybe ask some questions about whether they're going to actually need to do any kind of inquiry in order to increase that. That may be a good question to ask. A lot of times, credit card companies will just offer up those increases as well, and you can accept them. But I would say just contact the customer services and see what the options are for increasing the limit, and what that process is, and how it might affect your credit profile by doing that.
So I have another question. Thank you, Carmina. I have another question. When student loan debt has gone to collections, is it still considered student loan debt and unable to be resolved in bankruptcy?
Yes, so collections would just be really where it sits in the credit report. So what the status is, which would mean that, it would be a debt that somebody did not pay, and thus it has been transferred out of routine, account management into a collection status. So it really doesn't fundamentally change what the debt is. If it was previously not able to be included in a bankruptcy, the fact that it's become a collection, I don't believe, my understanding is that I don't believe that would change that.
So there's another question here between a soft pull and a hard pull. So there's two ways to pull credit. A soft pull just means that it's not a formal inquiry, an application for credit. And a hard pull means it's usually done by a lender who's actually going to potentially, because you've applied for credit, and they might actually extend a loan to you. Do I have that right, Carmina?
Yes. So a hard inquiry would be anytime, your credit is being required, your credit report is being accessed for the purposes of underwriting or some kind of application. And there's a lot of different reasons why a soft inquiry report could be pulled. Many times it's educational. So for credit counseling, for coaching, that kind of thing. But also, many agencies do promotional inquiries, which they're purchasing credit data, and they're looking at a high level screen of whether you might qualify. That's when you get one of those, you're pre-approved for this credit offer. That might come out of a promotional inquiry. Another thing that you might find on your credit report is your bank or your insurance company might do regular account screening. Those are also soft inquiries. So they're just monitoring their customers' credit. And again, that doesn't impact your credit score at all, but you might see it appear on your credit report, and that just alerts you that somebody's looking at your credit report, and that happens quite frequently.
So I see this other question: are there tools or tutorials to help increase credit score? There's a lot of data on the internet. I think Credit Builders Alliance is the best place to go. So I just encourage everyone to consider a membership and join and take advantage of all their educational materials. Let's see, what else?
Susan, that's another use of funder to ask your funder for, right? Yeah, ask them to pay for your
membership. We need a Credit Builders Alliance membership. Yep. We divert some of our funding to do that in these times.
Great. Yeah. And then I have another question in my chat.
Go ahead.
Some banks recently, Wells Fargo, not to name names, would not even talk to a customer about debt issues until they have already gone late for over a month. It appears there are no options for customers who are trying to be proactive. Can you?
Wow.
Is there anything to speak to that? I don't know if we're going to be able to speak to individual lender policies.
Yeah, I don't know, Carmina might have some, back in the last recession, the subprime mortgage problem, banks were unfortunately not very communicative with people in trouble, and it was really challenging. So I don't know, I'd like to think they're better now. I don't know what their practices are. If anybody has some advice about that. I mean, I know community lenders tend to be they want a relationship with their borrowers and are happy to talk anytime. Banks, especially the big national banks, you're looking at a big bureaucracy, could be hard, really hard to find someone who's willing to talk to you. One thing you can do, I think, is try to direct, to whatever extent you can, direct your clients, if they're going to try a bank, a locally owned bank. There's a locally owned bank where I live, Tri-Counties. They just seem to be much more approachable, much more willing to talk and have a relationship than the big national banks. Credit unions can be more personal and easy to talk to. And certainly on Cameo's website, you can find a list of all the community lenders in California that are members of Cameo, and look there. Looking for any other suggestions there.
Yeah.
There's another go ahead, Carmina.
I was just going to say, I think in the midst of the current crisis that we're in, I think, we are seeing a lot of lenders offering flexibility, setting up special hotlines for people to call, proactively providing options like deferments. again, it, like you said, it is up to each individual lender's policies and how they respond to this types of situation and just more generally. But I do agree that some of the local institutions might have a little bit more flexibility. I would say that an informed borrower can also ask specifically if there are options for forbearance or deferment, and having those specific terms to ask for might be helpful, especially if they're able to have a solution that they can pick back up on payments but avoid a negative impact through one of those options. And then for the specific crisis, when you have a natural disaster, you have a declared disaster like we're facing right now, there are special codes that lenders can apply to the file to avoid the negative impact on the credit score, even if a payment is missed, that they can utilize. So a borrower can also ask if they have any of those options available. So I think an informed borrower knowing what options might be available can help them when they're communicating with their lender.
Well, and we know that every California county is now eligible for the SBA disaster loans. So the entire state is eligible. So I'm not sure what the codes are for that, but yeah, go ahead, Heidi.
I want to add to that is that there is a disaster loan advance so that everybody should apply for that. You should get all of your clients to apply for the SBA Economic Injury Loan. The money's going to go and then it's going to run out. To have them apply, then they're advancing people who apply. I'm not sure if they're advancing everyone, but there's a good chance that you can advance get a $10,000 loan, even if you don't qualify for the entire loan. So if you're asking for 100,000, they'll give you 10,000 right up. Not that that's going to be anything but a loan.
Right. And I think we gave a little bit of information on last week's webinar. Is that on our disaster or COVID page?
It is. There's a link, and I posted the COVID page there. And apparently what we did last week is now outdated.
Well, we'll do the updated one as soon as we can, right?
And I think it's easy to apply. I think they've slimmed down the application process.
Okay,
so have...
but at least in that webinar, I think there's links to the right pages and places to go. Even if
I can pop that into chat as well.
Yeah, there were the links to where to even start the application process. So
here's the application.
We're advising people to just start. If you have clients who you think might possibly qualify, just throw their hat in the rings quickly and worry about the details later. Because as Heidi said, the money's going to run out and there's going to be some very affordable money at the beginning. So just go for it. Yep. And if you don't have to take it if for some reason you don't want it, but it'd be terrible to need it and qualify, but just be late in the process.
Yeah. So have your members do that. And I did want to put out there something that the federal unemployment is going to be for solopreneurs and independent entrepreneurs. I did want to put that out there because I'm sure some of your clients are there, and I'm sending around an email, so watch for it from Cameo about both of these with the links.
How to apply or get more information.
And the disaster loan is right there, Jesse. I just put the link into chat. So that's the application link. But yes, we will email both the disaster information as well as the unemployment insurance.
Yeah, and Heidi and I can sit here a little longer. I don't know if you can, Carmina. I think we're at the top of the hour. But we're happy to sit here for a few more minutes if there's questions. Can people unmute themselves if they want to talk? We have a pretty small group at this point, Heidi.
They should.
You can unmute yourself if you just want to ask a question.
If you want to ask a question, it doesn't have to be related to this. It could be related
any other COVID type question that we're trying to just pour out. We have a webinar tomorrow at 4:00 on, if you're a lender, how to create a deferment policy, how to approach deferments on your loan portfolio. So join us again tomorrow at 4 o'clock for more information. As fast as we can collect it.
Yeah, that's a really good one. This is Jesse. If I'm not on, somebody from EDFC will be on there.
Yeah, please join us. We're going to get you launched on some deferment ideas.
Hey, I had a question because this is a little bit of a refresher for me, but so I know that in the past we were doing microloans. Like, I mean, actually they were micro loans. They were like loans of like $250. But we were having the people borrow the money and then pay it back. And then one of the advantages of joining the Credit Builders Alliance was that we could potentially do the reporting, have the reporting done on the loan.
Right. Excellent. Thank you for bringing that up, Jesse. Yeah, one of Credit Builders Alliance great services is Credit Reporter. And it takes a while to get through that process. But if you want to help your clients build credit, you can make them very small credit building loans like Jesse's talking about, and then report to the credit agencies and help your clients start stepping into that space where they have a credit score and a good track record and learn how to manage debt. So that's a great idea.
And it gives a client a good practice, and you know, a lot of times they can actually use that money in a useful way. So
yeah, great idea. Thank you. Any other questions?
If anyone has any more information about resolving student loan debt, I would appreciate it. I have two people right now who are dealing with it. One has over $420,000.
Oh my God.
It's student loan debt?
Between her and her husband. They're both professionals, but their businesses have been decimated, and the husband is disabled now. And they've got a couple of children and mortgages and lots of.
No, I know someone who's a naturopathic doctor, and she didn't understand what taking on all that student debt to become a doctor was going to do to her. I mean, so it's a really big problem. Are there any resources, Carmina, that you guys have particularly about student debt in particular?
Yeah, one organization that I would recommend you check out would be the Student Borrower Protection Center. And they actually did a couple webinars for us last year that we have in our learning library. I don't know if you're with an organization that's a member, but feel free to reach out to me and I can help connect to those resources. But they've got two great webinars that they did. One about the kind of the student loan crisis, and then another one about more of a train the trainer of how to really help people navigate those types of issues. But you can also go to their site. They do a lot of really awesome webinars that are available. So I would check them out for sure as a good starting point.
And they're listed online, Student Borrower Protection Center?
Yes.
Okay. And
Renee, check with Jedi if Jedi's a CBA member, because then you might be able to access. No,
they're not.
Too bad.
I keep trying to get them to join.
Oh, we need to talk to Nancy about that. Okay.
And so the other person I'm dealing with has over $60,000 in student loan debt, and she's a single mother with 5 children, has a part-time little business which has just been decimated. And you know, she started out with $20,000 in student loan debt, and because she didn't pay it and she ignored it, it is now over $60,000. And I'm just cringing every time I think about it, but I don't know how to help her. I don't know what to do.
Well, maybe this center will have some ideas, Renee. Let's hope.
Okay. Thank you.
And if there's a different administration, not to get political here, there's lots of talk about forgiving some student loans. So maybe there's something in the future there. Anybody else? And Heidi put into chat if there's another topic you need help with. We're game for trying to put together a webinar on it and seeing what we can do to get you information. People have been very generous. Like Carmina, I just want to thank you again. Are you on the East Coast by any chance, Carmina?
I'm actually in Colorado. So
in Colorado, so it's not too late.
It's not too late. No.
It's not too late. I thought, oh my gosh, she's on the East Coast. This is a very late date for her, but she just jumped in today, and I want to just thank you so much for sharing your resources and your knowledge. And I'm really hoping people will consider joining CBA and taking
How much is
advantage
it
of
to join?
So it depends on what services you're going to be using. So if you are coming into just our community, it is an annual rate of $495 per year. And then if you're interested in pulling credit reports or reporting data, then the costs will change based on whatever services you're going to be utilizing.
Okay. And what time's the webinar tomorrow on the deferral policy?
It's at 4 o'clock. We like this 4 o'clock in the afternoon time because it gives us time to do them.
I'll post the registration link into chat right now.
Yeah, and if for I'm assuming everybody on this call is on Cameo's emailing list, but if you're not, please go to our website and just sign up to receive the our emails, because Heidi or whoever is in charge of that is sending out a lot of information. Okay, I think we're done, Heidi. It doesn't look like any more questions. So thanks everybody for joining us. I hope this was helpful. We can get you the slides and check out CBA.
Thank you
so
so much.
Thanks, everybody. You guys stay safe and healthy.
Yes, take care. Have a good evening, everyone. Thank you.